Hi students, good evening all of you. So coming to the next topic, accounting. First of all, what is meant by an accounting? Accounting is defined as it is an art of recording, classifying, summarizing, analyzing, interpreting the financial transactions and communicating results thereof to the users of financial statements. So it is defined as what? So it is an art of recording, classifying, summarizing, analyzing, interpreting the financial transactions and communicating those results to the users of the financial statements is called as what? Accounting. And this definition is provided by AICPA. AICPA stands for American Institute of Certified Public Accountant. American Institute of Certified Public Accountant. Okay. So here, first we discuss what here it is an art of what? Recording, classifying, summarizing, analyzing, interpreting the financial transactions and communicating those results to the users of the financial statements is called as what? Accounting. So I will explain it in one by one. So coming to here, the first one is what? Recording. First one is what? Recording. So recording is simply is nothing but the process of writing the transactions and events in a separate book. The process of writing the transactions and events in a separate book. And in accounting, first we have to identify the transactions and events. And next, we have to measure that transaction events in terms of money. In terms of money, because only monetary transactions are recorded in the books of accounts. Non-monetary transactions are never recorded in the books of account. And then this identified and measured transactions are recorded in a separate book is a nothing but what? Journal. Is a nothing but what? Journal. This process of writing the identified transactions in a separate book is called as what? Recording. Is called as what? Recording. And here, first of all, how to identify the transaction? How to identify the transaction? Remember, generally the transactions are identified by using a documentary evidence. Documentary, and you have to verify whether transaction is actually happened or not. For example, you go to the shop and you purchase the clothes. Then while making the payment, he gave the receipt to you. That receipt itself is said to be a what? So that is the evidence for incurring of the transaction, nothing but purchase of the clothes. Okay. So the transactions are identified by using a documentary evidence. In case of the purchases, so there is a purchase invoice. In case of the sales, there is a sales invoice. In case of the cash transaction, receipt of the cash, receipt voucher is there. Payment of the cash, payment voucher is there. and bank transactions are identified with the passbook. So in that way, and in case of bills related transactions, we identified by using the bill. So every transaction is identified by using a documentary evidence and is technically called as what? Voucher. And is technically called as what? Voucher. That identified transaction is required to be measured in terms of money or money's worth. And those transactions are called as what? Monetary transactions. As per money measurement concept, only monetary transactions are recorded in the books of account. And that measured transactions are recorded in a separate book, and that book is called as what? Journal. And the book is called as what? Journal. And here the identified transactions are first recorded in the journal. That's why we call it as book of primary entry. Book of primary entry. Book of primary entry. And the transactions are recorded in the journal as and when they are identified, or as and when they are incurred, as and when they are identified, or as and when they are incurred. And that order is called as what? Chronological order. And we have to record the transaction on date wise. We have to record the transaction on what basis? Date wise. Okay. The process of writing the transactions in the separate book is called as what? Recording. Is called as what? Recording. Then coming to the second one, classification. Second one is nothing but classification. So here, for example, we recorded the total transactions during the year. At the end of the year, you wanted to know, so that what is the total amount we spent on purchase of the goods. Then you required to go back to the first page of the journal, and at every day you need to verify what is the total purchases and required to be noted at one place. And at last, after completion of the every page, you need to total it. And it is a time taking process. And for simplifying that, the similar nature of transactions of a particular item are combined together and mentioned at separate statement is called as what? Account. These all accounts are maintained in a separate book is called as what? Ledger. And that whole process is called as what? Classification. Is nothing but what? Classification. So classification is nothing but what? The process of analyzing the recorded data in journal by pooling the similar nature of transactions of a particular item. The process of analyzing the recorded data in the journal by pooling the similar nature of transactions of a particular item and mentioned at one place called as account. Mentioned at one place called as account. All accounts are maintained in a separate book. That is what? Ledger. All accounts are maintained in a separate book. That is called as what? Ledger. And the whole process is called as what? Classification. And the whole process is called as what? Classification. Simply is nothing but the process of transferring the recorded data from the journal to the ledger. It's the process of transferring the recorded data. First, the identified transactions are recorded in the journal. And from the journal, the transactions are required to be transferred to what? Ledger. And this process of transferring the transactions from the journal to the ledger is simply called as what? Classification. Is simply called as what? Classification. Okay. So this is nothing but what? Analyzing the recorded data in the journal is called as what? Classification. Okay. And the classification is done in a separate book called as what? Ledger. Classification is done in a separate book called as what? Ledger. Okay. And third one is summarizing. Summarizing is nothing but the simply a statement prepared by way of by considering the summary of all accounts maintained in the ledger. All accounts maintained in the ledger is called as what? Summarizing. Is called as what? Summary. Simply the process of summarizing the all accounts of the ledger at one place called as what? Summarizing. In summarizing, three steps we have. Two steps are there. One is the preparation of trial balance. Trial balance simply is nothing but it is a statement prepared by considering all accounts we maintained in ledger. And the second one is preparation of financial statements. So preparation of financial trial balance and the preparation of what? Financial statements is called as what? Summarizing. And here financial statements are nothing but simply those are the organized documents prepared by the entity to know the financial results and financial position of the entity. It is a organized document prepared by the entity to know the financial results and financial position of the entity. Financial results are generally measured in terms of what is the profit or loss during the year and profit or loss during the year. Financial position is representing the strength and the weakness of the entity in terms of the finance. The strength and weakness are generally mentioned in terms of what? Assets and the liabilities of the entity. Assets and liability. And exactly what is meant by financial result and financial position, I will tell you at the end of the this class. Okay. So summarizing is nothing but simply the process of preparing a summary statement of all accounts we maintain in the ledger. That summarizing is generally consisting of two things. One is the preparation of the trial balance. Another one is preparation of the financial statements. And financial statements are generally used to know the financial results and the financial position of the entity. Clear? Next. Analyzing. So analyzing is nothing but the process of analysis of financial data considered in financial statements. Considered in financial statements. And we have to analyze that financial statements. Analyze that financial statement. Generally, this analysis, so you have complete discussion about the analysis in CA Inter or CMA Inter is nothing but what? Ratio analysis. And the best example is GP ratio and gross profit ratio, net to profit ratio, asset to turnover ratio, etc. And here it is done, this process is generally done by establishing the relationship between two items of profit and loss or two items of balance sheet or one item of the P&L, one item of the balance sheet. And it established the relationship between balance sheet and profit and loss statement. Balance sheet and profit and loss statement by way of analyzing it in a simplified manner to make the data in very understandable format to the users of the financial statement. And for doing this analysis, the total assets are grouped, classified into two types: current assets and non-current assets, liabilities into current and non-current. All current assets are grouped together and mentioned at one place. All non-current assets are grouped together and mentioned at one place. Same way, current liabilities are mentioned at one place, non-current liabilities are mentioned at one place, and this is generally done as a part of what analysis. Okay, simply it is the analysis of the data we considered in the financial statement. Simply nothing but analysis of the financial statement is called as what? Analyzing. And how we analyze? By doing the ratio analysis. And by doing ratio, nothing but by way of establishing, nothing but it establish a relationship between profit and loss account and balance sheet. Establish relationship between profit and loss account and balance sheet. How, sir? Like, for example, asset turnover ratio is there, and we consider assets from the balance sheet and the turnover from the profit and loss statement. And by establishing the relationship in terms of ratios, and we analyze the financial statements. Okay, and fifth one, interpreting. Interpretation is nothing but simply is nothing but it is providing the exact meaning of the items we have in the analysis. Exact meaning of the items in the analysis. It provides. So it provides exact meaning of the items we considered in analysis stage of an accounting. They nothing but what, for example, what is meant by current assets and what is meant by non-current assets and what is meant by liability, current liability and non-current liability. That the definitions are provided, and without that, and the main objective of considering the number of stages as a part of an accounting is nothing but to simplify the financial statement in more understandable format to the users of the financial statement. Even if the user is a layman, if he is having a basic knowledge about the accounting, then he will able to understand the financial statement by considering these all steps. Okay, and that is the main objective. We make the financial statement in a understandable format to the each and every person of the user. Okay, and the last one, the last stage is called as what? Communication. Communication. So communication is nothing but the process of transferring, the process of transferring the analyzed data to the users of financial statement. The process of transferring the analyzed data to the users of the financial statements is called as what? Communication. Is called as what? Communication. Okay. So this is what is meant by an accounting. So accounting simply is nothing but what it is, an art of recording, classifying, summarizing, analyzing, and interpreting the financial transaction and communicating the results thereof to the users of the financial statement is called as what? Accounting. It consisting of generally six stages are there. One is recording, second one is classification, third one is summarizing, fourth one is analyzing, fifth one is interpreting, sixth one is communicating. Actually, accounting was completed by these three steps previously: recording, classifying, and summarizing. And the remaining stages were added later on as a part of the globalization. So we need to communicate to the users of the financial statement. If you provide the financial statement directly to the users, they may unable to understand exactly what they provide, what the business provided. That's why, to make them in very simple format, some more stages added as a part of the definition of an accounting. Nothing but what? Analyzing, interpreting, and communicating. Communicating. So these six stages are there in accounting. Okay. And here in communication stage, we use the word users of the financial state. Users of the financial state. And generally, what is meant by user and what is meant by financial statement, both are important. And coming to the financial statements are nothing but what? Those are the organized documents prepared by the entity to know financial results and financial position. Financial results and financial position. And financial results are generally represented in terms of profit or loss during the period. Financial results are generally represented in terms of profit or loss. And financial position is representing the strength and weakness of the entity in terms of finance. So the profit or loss during the year is identified, is ascertained by preparing trading account, profit and loss account. Financial results are ascertained by preparing what? Trading account and profit and loss account. And financial strength and weaknesses are identified by preparing what? Balance sheet and cash flow statement is that. Balance sheet and cash flow statement. And together, one more document we prepared called as notes to accounts. Together, one more document is prepared called as what? Notes to accounts. And these are considered as a part of the financial statements. What are those? Trading account, profit and loss account, balance sheet, cash flow statement, notes to account. Actually, one more element is there, which is generally considered as, in case of company, nothing but statement of changes in equity. Statement of changes in equity. And we'll discuss it in later. Okay, these are general. And here, the trading account and the profit and loss account are generally called as income statement. Income statements, which are used to ascertain the financial results of the entity, nothing but what is the current year profit or current year loss. And financial position is ascertained by using the assets and liabilities of the entity and by preparing what? Balance sheet and the cash flow statement. And cash flow statement exclusively used to calculate what is the cash position of the entity. What is the cash position of the entity? And these are generally the forming part of financial statement. So financial statements are nothing but those are the organized documents prepared by the entity to know financial results and financial position of the entity. Financial results and financial position. And in general term, for example, if you consider a classroom and there your marks is said to be a result. Your marks is said to be about result. What is your rank in the class is indicating what position? Is indicating what position? So in the same way, coming to the business, the results are measured in terms of what is the profit or loss during the year, and position is measured in terms of what assets and liabilities by preparing that position statement. And these are all called as what? Position statement. Position statements. This is what is meant by financial statement. And one more word is there called as what? Users. What is meant by user? User is nothing but the person whose decisions are affected by the decisions of the management are called as what? User. The person whose decisions are affected by decisions of the management, or it is defined as simply is nothing but the person who is using the financial statements of the entity. The person who is using the financial statements of the entity. For what purpose they are using? For taking the decisions. For taking the decisions. So whether they will continue with the organization or not. In case of employees are there, employees are required that financial statement to know whether company is having profits or loss during the year. If the company is a entity is having the profit, then they may expect some increments from the entity, from the management side. So if the entities are having the losses, then they didn't have that such type of expectation. And coming to the investor, and based on that position or results earned during the year by the entity, they will decide whether they may invest in the business or not. So in this way, for taking the decisions related financial decisions relating to that entity, the persons are requiring the financial statement, and those are called as what? Users. And users are generally classified into the two types. One is internal users, another one is what? External users. Internal users are simply is nothing but the persons who involve in managerial decisions of the entity. Managerial decisions of the entity. Those are called as what? Internal users. Who are there? Like owners, shareholders. Management is nothing but what? Board of directors, managers, key managerial person. Generally, key managerial person and managers are these all are forming part of the employees. But every employee is not forming part of internal user. Out of the employee, all employees, some persons involved in day-to-day managerial decisions of the entity, those are only covered under the definition of internal user. And coming to the external users, suppliers or called as creditors, customers or debtors, employees other than key managerial person, employees other than key managerial person. So, and then nothing but managers and board of directors, etc. And those are covered under internal user, like financiers, nothing but what lenders, government at last for public, government at last for public. And you may have a doubt like, and for example, coming to the financials, why they require the respected financial statements of the entity. Financiers wants to verify whether entity able to pay their dues within the due date or not. In case of financials, two types of obligations we have relating to the financial. One is regular interest we liable to pay, and the total amount we liable to pay after some period. Are we able to meet the regular interest at the end of the regular interval of time? Are we able to meet that whole obligation principal amount after some period or not? That credibility is analyzed by the financials by using our financial statement. Same way for banker. And employees, they want to know information about the hikes or increments, etc. Government wants the financial statement to know whether that party is paying tax as per tax on the total income or not, whether that entity disclosing the total income earned during the year to the government or not. So in this way, these persons are generally involved, generally linked to the entity. And these are generally surrounding the business, called as users. The persons who are using the information relating to the entity are covered under the definition of what? Users. Okay. So this is what is meant by users and financial statements. Okay. Users and financial statements. I hope you guys understood. Okay. And next. And next one, objectives of an accounting. And we will draft these objectives from the definition of the accounting itself. Okay. And what was the definition we discussed? Accounting is nothing but what? It is an art of recording, classifying, summarizing, analyzing, interpreting the financial data, and communicating the results thereof to the users of the financial statement is called as what? Accounting. So here the first objective is to record the financial transactions in a systematic manner. To record the financial transactions in a systematic manner. And what is meant by systematic manner? Systematic manner means what? You have to record in chronological order or analytical order. Generally, chronological order followed in case of journal, analytical order followed in case of ledger. Analytical order followed in case of ledger. And it means in case of the first objective, it covers two elements. One is recording, and the second one is classification. Second one is what? Classification. To record the financial transactions in a systematic manner. That is the first objective of an accounting. Okay. And second one, to ascertain financial results during the period. And financial results is ascertained by preparing income statement. Is nothing but what? Trading and profit and loss account. And which is forming part of what? Summarizing step. Which is forming part of what? Summarizing step. to ascertain the financial results during the period. And third one, to ascertain financial position of the entity. So financial position is ascertained by preparing position statement. Position statement consisting of a balance sheet and a cash flow statement. And these two are also forming part of our summarizing step. Okay. Also forming part of our summarizing step. What is the first objective? To record the financial transactions in a systematic manner. Second one, to ascertain the financial results during the period. Third one, to ascertain the financial position of the entity. And fourth one is to communicate those results to the users of financial statement. To communicate those results to the users of financial statement. And when we communicate, so after completion of what analysis, interpretation, and then only we can communicate. So the analyzed and interpreted data will be transferred to the users of the financial statement is called as what? Communication. Is called as what? Communicate. We are communicating the financial information of the entity to the users. We are communicating the financial information of the entity to the users. And that's why. So remember, accounting is called as language of a business. Accounting is called as what? The language of the business. Language of the business. So how the business is communicated with the outsider? If you want, if the business required any loan, then they need required to communicate with the lender. How they communicate? By transferring the financial statement. So that's why accounting is treated as a language of the business. Language of the business. Simply, this is the information about what accounting. So in this lecture, we discussed what is meant by an accounting and what are the stages involved in the definition of the accounting and what is meant by user and what are the types of the users and the financial statements and what are the components of the financial statement. At last, what are the objectives of the objectives of the accounting? So these what we discussed in this lecture. I hope you guys understood clearly. Okay. So this is what is meant by accounting. Okay. And thank you. And everyone, please like the video and it is very important to the every commerce student and better to share the video to the newcomers and who wants to learn the accounting and to the beginners of the accounting. Everyone may follow these lectures and you will get clear understanding about the financial accounting throughout this lecture. Okay, so thank you.